building upon the distinction between residential and commercial properties. A critical area of competency for Arizona real estate professionals is understanding income-producing properties, those acquired or managed with the intent of generating revenue. These properties can range from small residential rentals to large-scale commercial investments, such as office buildings, industrial facilities, or retail centers. Mastery of this topic requires knowledge of financial analysis, disclosure requirements, and ethical duties under the Arizona Department of Real Estate, ADRE standards, and the Commissioner's rules, specifically AAC R4-28-1101H and R4-28-1101I, which require licensees to act competently and disclose all material facts relevant to a transaction. An income-producing property is defined by its ability to generate consistent cash flow from rental payments, leases, or other sources, such as vending services or parking fees. In Arizona, these properties include multi-family housing units with 5 or more dwellings, retail centers, office buildings, hotels, and industrial complexes. The primary focus for investors is not personal use, but return on investment, ROI, a financial measure that evaluates profitability relative to costs. Competent agents and brokers must understand the financial indicators that determine a property's investment value, including gross income, net operating income, NOI, capitalization rate, cap rate, and cash-on-cash return. For example, if a client is considering purchasing a 10-unit apartment building in Mesa, the agent must analyze the rental income, subtract operating expenses such as maintenance and management fees, and determine the property's NOI. This figure, when divided by the property's purchase price, produces the cap rate, a key metric investors use to compare potential returns. If the building produces $120,000 annually and expenses total $40,000, the NOI is $80,000. If the purchase price is $1 million, the cap rate is 8%. A knowledgeable agent must be able to interpret these numbers and communicate them clearly to their client, ensuring compliance with the duty of reasonable skill and care. In addition to financial evaluation, income-producing properties involve unique disclosure obligations. Licensees are required under ARS Section 32-2153 to disclose all known material facts that could affect the property's value or desirability. These include existing leases, tenant payment histories, operating expenses, maintenance obligations, and any pending legal disputes. Sellers must provide rent rolls, copies of current leases, and statements of income and expenses. The failure to disclose these critical details could result in disciplinary action, contract rescission, or civil liability. For instance, if a seller fails to disclose that several tenants in an apartment complex are delinquent on rent, or that a major tenant in a shopping plaza plans to vacate, the buyer could suffer substantial financial loss. Under Arizona law, such omissions constitute misrepresentation or concealment of a material fact, violating both ARS Section 32-2153 and the Commissioner's Rule R4-28-1101I. A competent agent ensures all material information is verified and presented transparently. Another crucial element in income-producing property transactions is environmental due diligence. Arizona's Environmental Quality Act and related federal laws, such as the Comprehensive Environmental Response, Compensation, and Liability Act, CERCLA, place responsibility on property owners for environmental contamination, even if they were not directly responsible for it. Competent brokers should recommend environmental assessments, commonly referred to as Phase 1 and Phase 2 environmental site assessments, especially in commercial transactions involving former industrial or agricultural sites. Failure to identify contamination early could result in costly remediation obligations for the buyer and potential liability for the broker. Disclosure of property management and expenses is another key aspect. Investors purchasing income-producing properties must understand whether management will be handled personally or through a professional property management company. Under ARS Section 322173, property managers must be licensed if they handle funds, negotiate leases, or manage properties for others. Therefore, an agent should verify whether management agreements are in place, who holds trust accounts for tenant deposits, and whether the existing manager complies with all ADRE requirements. A practical example of these duties in action might involve a buyer purchasing a retail strip center in Chandler. The listing broker provides rent rolls, but fails to disclose that one of the tenants is operating under a month-to-month lease instead of a 5-year term as represented. The omission affects the property's projected income and ultimately its appraised value. The buyer later discovers the discrepancy and files a complaint with the ADRE. Such a case would likely result in disciplinary action against the broker for failing to exercise reasonable skill and care and for misrepresenting a material fact. It is also important to understand that income-producing property sales are often subject to commercial lease transfer obligations and estoppel certificates. An estoppel certificate is a legal document signed by a tenant confirming the terms and status of their lease, including rent payments and any disputes. This document protects both buyers and lenders by verifying the income stream and lease compliance before closing. Failure to secure estoppel certificates, when required, could jeopardize financing or lead to post-closing disputes. In short, an estoppel certificate is used whenever you need verified, binding confirmation of the current status of a property, lease, or financial obligation before completing a transaction. Competent brokers also guide clients through tax considerations such as depreciation, cost recovery, and 1031 exchanges. A 1031 exchange, authorized under the Internal Revenue Code, allows investors to defer capital gains taxes when exchanging one income-producing property for another of equal or greater value. For example, an investor selling an apartment building in Tempe could use the proceeds to purchase a commercial office building in Phoenix without immediate tax liability, provided the exchange meets IRS deadlines and qualification rules. A licensee should recommend consulting a qualified intermediary or tax professional to handle the 1031 transaction in compliance with federal and state regulations. Review summary. Income-producing properties are defined by their capacity to generate income through leases or business operations. Successful transactions depend on understanding financial metrics, such as NOI, cap rate, and ROI, conducting proper due diligence, and fulfilling all disclosure obligations. Licensees must ensure full transparency regarding leases, expenses, tenant histories, environmental conditions, and management structures. Competency in handling these transactions not only fulfills the fiduciary duty of care, but also protects clients from financial and legal risk. Discussion prompts. What distinguishes an income-producing property from a traditional residential property? Answer. Income-producing properties are purchased primarily to generate revenue, while residential properties are typically used for personal habitation. What disclosures must be made in an income-producing property transaction? Answer. Disclosures must include rent rolls, lease agreements, tenant payment histories, property expenses, and any known environmental or legal issues. Why is financial analysis, such as determining cap rate and NOI, essential in evaluating income-producing properties? Answer. Because it helps investors assess profitability and compare potential returns between properties. Closing remarks. Identifying and managing income-producing properties requires a higher level of financial literacy, legal understanding, and ethical responsibility. Arizona licensees must go beyond facilitating transactions. They must interpret financial data, evaluate risk, and ensure complete disclosure to protect their clients' investments. Competency in this area strengthens public trust in the profession and supports the core purpose of real estate licensing in Arizona: to protect consumers through education, integrity, and professional excellence.